Right. So today we're going to be speaking about property joint ventures because there can be different types of joint venture. It can be business joint ventures, and then more specifically, property joint ventures and how to structure one. This is aimed at, in reality, two types of audience. Either it's aimed at people that have got some amount of money, want to put that into a property and see some good returns, but don't have experience or the time to do that, then obviously a joint venture can work well for that. And the other thing is for people that are doing property developments, maybe you've got a good deal, have got the time to get it over the line and get some good profit on it, but don't have the capital needed, in which case then it's, yeah, bringing in the potential joint venture partners. And as an introduction, where I come into this, obviously I've got a number of joint ventures where I'm the developer or in partnership with the developer, and we're looking for hands-off investors. And then the other thing that I do, there's a number of people that I work with who maybe don't have a big amount of experience in how to set up a joint venture. And there I'm doing a bit of mentorship and guidance on how to do that. Or it might be simply like a one-off consulting type thing. So yeah, there's a developer's got a deal. He's maybe got some friends or some contacts that are interested in coming into the deal to put some money in there, but they need a bit of help on structuring that, make sure it's all done legally sound. I'm obviously not a legal professional, but obviously got experience in doing this, and then we use the solicitors for the appropriate parts, and we're going to speak a bit about that. And obviously we get also accountants on board and brokers on board, because yeah, when it's a joint venture, the lending also can be a bit more tricky because there's different people involved. So we're going to get into the presentation. So what is a joint venture? So a property joint venture is a collaborative agreement between two or more parties. And generally we've got the investor partner who's contributing the money or a significant part of the money into the deal. And then we've got a principal partner. I generally call this also founder partner, who contributes the time, expert and expertise, management skills, and generally also who has found the deal. So why is it important? It enables investors to access high yield projects without like doing all the work. And in practice, and we're going to see this right at the end, we've got a table that compares the different options. An investor, let's say an investor's got £100,000 at hand. There's two things you can do. Well, lots of things you can do with £100,000, but in property, or let's say if it's 100 or maybe £200,000 in other areas, you can get a buy-to-let house with £100,000. You can get a buy-to-let house in one of the cheaper areas of the UK. Potentially, you can do what's BRR, which is buy below market value, renovate, and then get some of the money back out. And you're probably going to be getting a yield of maybe between 6, 7, maybe up to maximum 10% on something like that. Whereas when it's like a bigger project, like the things that we do as joint ventures, which most often they're things like commercial to residential conversions, there it's possible to achieve like 15 to 20%. But obviously, a joint venture means doing it with other people and being comfortable about effectively being in a joint venture partnership with other people. So, how a joint venture works. So, first of all, there's a principal or the founder partner that is finding a project where obviously there's sufficient margin so that everyone can get something out of it. One thing I'm going to add at this point is that the principal partner or the founder partner, it can be one person or it can be two people. To give like, yeah, practical example of joint venture that I've done as founder partner, I would say that probably half of them has been only myself as a founder partner. So I'm looking at finding and looking after all the development, and then there's the investor partner. But also, and this can actually also work really well, the founder partners is myself and another person who's experienced in some area of property finding, property development. And that can be really good because then it's not one, if one person is thinking, well, how can we do this, or gets a little bit well, disappointed or thinking this is too hard, then you've got the other founder or business partner saying there's nothing hard about this, you just have to sort of sort it out, sort of thing. And it can work both ways to yeah, to progress a deal a lot faster. So we've got the deal. We've got the founder partners who are the experienced developers, and then we've got the investor partners who are coming in, bringing the money. In general, we're always using bank finance. So if it's a conversion project, typically we'll be using bank finance to cover between 60 and 70% of the purchase cost, and most of, or sometimes 100% of the development costs. Although when we've got the development costs covered, the bank only pays the first part of the development cost when we've done some of the work. So generally the capital needed is the deposit money, all the legals and things, and we're generally looking also to have at hand 10% of the development costs. So there's always going to be a joint venture agreement defining how much people are investing, what's the profit sharing ratio, timeline, responsibilities, and what's the exit strategy, what we're going to do at the end. And then obviously once we've got this all agreed, we're going to be buying the property and sorting out the finance and starting working on the renovation or the execution, the development. Sometimes a joint venture partnership, it can be with almost no physical work because we've got multiple types of property project. It could be simply something where we're buying a freehold block of flats, for example, at a maybe below market price because the owner wants to sell it fast. And then we're going to be splitting the title up into individual flats, selling them off for a profit. And then basically at the end, it's a profit share between the property developer doing all the work. But in practice, it's more like paperwork. It's not physical building work. So that's why we call it project execution, not specifically always development. And then the exit and returns. At the end of the project, we've got different possibilities. Either we sell the project, so we sell the flats or the development that we've done, and then we've got a profit that is split between the, obviously we're going to repay back the bank lending, repay the investor capital, and then generally there's a profit share. In most cases, a 50/50 profit share between the investor and the developer. And then the other case is when we're refinancing and holding a property. Generally, we're doing that if we've got something which has got like more value than a standard buy-to-let. So if we've got one project, for example, on the go at the moment, which is a commercial to residential, but we're going to be doing service apartments with it. And on this case, we're going to refinance it. The investors get some of their money back, half of their money back in reality, and then they've got ongoing share of ownership and an ongoing share of income. Maybe Keith, I don't know if you'd like to add anything or have you got any questions or comments before we move on to make it a little bit interactive?
So, you mentioned one of your projects, commercial to residential, you've got SA units in it. the SA units, how long do they take to refinance? I'm only understanding that.
So there we've got two things. We're on, I've actually got this on a later slide. But in reality, what happens is when you're doing serviced accommodation, it's difficult to get finance based on the accommodation income without at least 1 year and generally 2 years of trading income.
Yeah.
So what we do in this case, in this particular one, it's three residential apartments, which we just happen to be going to use as serviced accommodation. So they're going to be refinanced on the sale basis of three individual dwellings.
Okay.
So in this case, and the stress test for the lending is going to be on the AST, so the the standard rental income on that. The banks might be, because we're going to give some figures and of similar properties and things, the banks might be a bit more tolerant to the stress testing because we've got operating as serviced accommodation, but the value is going to be based on the basically the bricks and mortar value of resale. And on something like that, the strategy is to go for a 2 year, is to go still for term lending because obviously it's got lower interest rates, but get to go for a 2 year fix. And then after the 2 years, typically we would get a new valuation and potentially, depending on interest rates, etc., at that time, potentially refinance to be able to get additional money out to return to investors.
Or,
Or
or, or
depending on the shareholders, if everyone says, look, we're going to get some money out, let's start some other little project, then we can also do that.
okay, so following what you've said, 2 year fix as a buy to let rental, 2 years worth of trading. So you'll obviously get a revaluation from a normal buy to let mortgage, but obviously if it's performed really well as a service accommodation, you not get a higher value at that time.
It would be a higher value at that time.
Right.
And also potentially higher value because property prices have gone up as well. Yeah, so they're able to refinance and get additional money out.
Okay. No, I asked because I've got well, it's been paid back, but I know somebody who I had invested in where they've created some SA units, and I was wondering, I didn't really ask them how they were going to get the financing back out, because if we paid me, so it wasn't really my business, but it's good to know that's how you do it. So thanks for that information. That's
Yeah,
quite
yeah. And we've got another joint venture project on the go at the moment, which is this is a bigger one. It's a conversion of a social club into this is going to be mixed use. So on the ground floor, it's commercial, so it's got shops, cafe, restaurant type thing as well. And then the first and second floor, we're going to be converting to flats, probably 9 flats. And on this one, we haven't currently got, we obviously we're working on the planning permission. We've got a successful, a favorable pre-app response. On this one, we've got it on a 18-month bridge,
no?
which is not without any development finance. This is just to be able to hold it to get all the commercial space rented out,
Yeah.
to get the planning, and at that point we can go into a different bridge at a probably considerably higher value because A will have got all the commercial space rented out. So we've got the commercial income and
Yeah.
we've got the proper planning on the rest, which obviously increases even though the planning isn't done, that increases the overall value of the building.
Okay, so the bridger was happy with you going for the planning at the same time then.
Yes, yes.
Okay, well that's interesting.
Yeah,
Yeah.
so there, yeah, we explain everything to the brokers and to the lenders. We say what we're going to do with it. What we can't do in this bridge, because this is a bridge to purchase and to basically rent out the commercial space without any major changes of use, is when we're ready to start breaking things and do the real development work, which is when we've got all the planning and stuff. At that point, we have to re-bridge to get out of the initial bridge. because generally the lender wouldn't consent to major works. It basically a new situation. But that is good because in practice on this deal, what the plan is when we get to the stage of refinance to start the development, we're looking to do that within 12 months, not 18 months. We'll have added sufficient value so that we can actually repay at that point the joint venture financial partners.
Okay.
Because this particular project, if we look at the principal partner, is two people. It's a guy called Kirill. Sometimes he takes part in the stuff. So we're doing that together. We've got so obviously we sorted out the bank lending, which was at 70% loan to value. And then we've got a private investor who's put the funds in for the rest of the purchase. And
Right.
also we've got like a cash flow of around 50,000, which will basically cover the planning costs and a bit of work to get the commercial space rented out.
No, that's what I love about you. You know, you get creative with all of these. And as we know, the financing is very important. And if you can do it in a way that suits the project,
That's
uh,
right, yeah.
the
And because we're giving in reality and this is a big advantage of going into a joint venture project. The investors that come on board at this stage, they're even though obviously they can look at the risks, we've got different exit plans on it, so we don't consider there's any major risks on there.
yeah,
But the investor partners get quite a high level of return. There's probably going to be this one is going to get probably 30%, potentially over 1 year to like 14 months,
yeah,
which is obviously a really good return on the. If this person were to use that money, I think it was like something like 150,000 that went in. If they were to use that money to on a buy to let, then obviously we know what returns they're going to get. It's going to be a few percent.
yeah.
So
Uh,
maybe after 1 year, that 150 might be worth maybe 155, 160.
right.
Whereas in a joint venture, 150 that goes into it in probably 1 year to 18 months is worth 200.
Yeah, I understand. So with this one, you said you've done a pre-app. Was that pre-app because you were advised to do that in that location, or was that this to aid your proof of concept for the planning uplift to the
Yeah,
project?
it was more to, in fact, it's for two things. Because of the size of development and quite a few planning authorities say specifically that they prefer a pre-app to be done. And so if you go directly in with full planning, it's considered pretentious and it's a psychological as well. And you can end up getting it refused.
Well, you
Whereas if you go in for the pre-app and you've got a favorable pre-app, obviously it's not binding, but you know where you stand. And we do that in places where we can get a pre-app over the line in like 1 to 2 months.
all right. So you're saying in that particular location, the pre-app is a lot faster than going through planning.
Yes, it is. Yes.
Because of the time asset, it's worth
Yeah.
the pre-app in
Yeah.
that.
Because interestingly, I was speaking with some developers in London this morning. And there I was saying generally we do pre-app on our stuff. They were saying, well, they're doing stuff like in Westminster and some other London boroughs.
Yeah.
They say we always go directly in for full planning because the pre-app takes so long.
Yeah.
It can be like 4 to 6 months for a pre-app,
Yeah.
and then you've got another 4 to 6 months for planning.
Yeah. So really,
Whereas in this case, and as well, when we've got a joint venture with staged investor input, we'll have maybe a higher risk investor at the beginning. So in other words, if there's a bit of planning risk, then the investor who comes on at that stage is going to get a higher return. So we
right.
don't need so much money. Maybe we need 50,000 to look at things and maybe secure an option or something like that.
Okay.
And then when we get to if you've got a successful pre-app, then we can do a second round of raising funds. And in that case, obviously, the return on those funds is going to be less because we've already de-risked the project.
But obviously, presuming you've got the right team or planners or architect behind you, you go for planning knowing that you should get it. The evidence is out there, or the experience or the local contacts is there that you know you will get it. Because with planning, sometimes you know you'll get it, but it's just how long it's going to take.
That's right, yeah. I mean, pre-app is not an absolute guarantee, but it gives a very high level of level of return. And if the pre-app says these policies like correspond sort of thing, afterwards, if they say something different, then there is likely you can
Well, I'm glad you're talking about these because I wasn't, I've never heard anyone use the pre-app in regard to helping aiding the raising of funds for the project.
yeah.
And I like the way you describe it. And
Yeah, that actually has a significant because and this is part of the thing as well, that when we're doing like consulting and helping developers set up their joint ventures, they might have an investor who's saying, look, we've got all this planning risk. I'll come on board, but I want this percentage return. So he's saying to them, look, let's divide it up into small parts. Give the higher return before the pre-app, and then as you go forward,
yeah,
as the risks go down, I mean, it can potentially be the same investor. So you can say to the investor, "We'll give you a preference on the second round, but the second round is going to be a lower percentage," that sort of thing.
no, I like the strategy actually. Because I've got someone just trying to interest me in a planning uplift project as well, and I've done it before on some peer-to-peer stuff. But what I've noticed is that even with the best will in the world, getting planners or architects or people who are involved with the planning in a particular a local authority, again, sometimes there's no guarantees you're going to come out how you plan, because we all know how some of the councils and all that are a bit fickle, and they're forced into go committee, and then it's extended time, and
That's
uh,
right, yeah.
sometimes we just make up the reasons or excuse for them to not proceed.
Yeah, that's right, yeah.
Okay,
Oh,
interesting.
good.
Okay.
I'm going to carry on with a few slides.
Sorry, Trevor.
That's good, yeah. So let's see what's next. Yeah, so roles and responsibilities. So we've got the principal partner or the founder partner, yeah, finding and negotiating the deals, managing everything, overseeing day-to-day operations. When it's like a big project, there's going to be a project manager appointed. The principal partner also generally is not putting any money in, or it might be a small amount because obviously their money is typically deployed in other projects.
No.
And the developers have got more projects and obviously they have their own funds for, so we like sharing that. But quite often, depending on how it's structured, the founder partner will give a personal guarantee on the lending and will be backing the lending. There's a small comment here. Again, these are parts of the things that we advise on. Generally, if a shareholder has got more than 20%, or in some lenders 25%, the lenders will require them to give a personal guarantee. And one of the ways around that is to have different classes of share, where an investor shareholder can have, for example, 19% of the shares, but those shares will still give maybe double the share of distribution of income, double the share of equity. But on Companies House, the actual number of shares, which is what and also number, it's also someone's got more than 25%, they can be a PSC, person of significant control.
Yeah,
So there's a whole load of things that need to be adjusted to be able to deal with who's going to be signatory to the loans. In some cases, it might be a big project where the investor is happy to have their name on the lending. And in that case, because typically a joint venture partnership is 50-50, but when the investor partner is happy to back up the lending, it might potentially be a project which is bigger than the assets of the founder partner, in which case the investor partner is going to have a higher share because they're also putting their name onto the project. And on
Okay.
things like that that I've done where it's the investor partner who's also basically providing a personal guarantee, then the share generally goes up like 60-40 towards the investor partner. And also generally, and this is all part of the shareholders' agreements, we generally agree that the company will pay for personal guarantee insurance for
Oh,
any director or shareholder. That obviously that doesn't cover 100%, but it can cover up to typically 80 or 90% of the amount that is
right.
guaranteed by a director.
Okay. Limit the downside.
Sorry?
Limit the downside to that
That's
person.
right, yeah. Limit the downside, or in some cases, make the deal possible. Because if the lender sees that there's an insurance covering the personal guarantee, that means that the assets that the guarantor needs to have on their asset and liability statement is a lot less than if they have to guarantee the whole amount.
Yeah, because obviously the insurance will kick in, won't it?
That's
Yeah.
right, yeah.
Oh,
So, yeah, and this is all the sort of thing that obviously we need to look at and that we are generally sorting out for on the different agreements.
and
So, yeah, for investors, gives access to larger scale projects, higher potential returns, typically 20% or more, and also portfolio diversification. Someone that's got two or three buy-to-lets, maybe they've got a mixed use, then it enables them. So they've got something that's like they've got 100% control of, giving them some income. And then to like grow it more, going into a joint venture is a good, it's like, yeah, it's like diversification in the same way as like branching out in, if you've got residential property, branching out into commercial property can also be, yeah, good diversification.
oh, right. Okay.
And yeah, for developers, obviously, it's to get funding to be able to take on bigger deals. And it's, yeah, building long-term partnerships for future projects. Quite often, people that come out of a joint venture project, obviously, if it's been successful, generally asking, what can we do now?
Yeah. Yeah.
And some people are saying, even before it's finished, what can we do now?
If you're a wise person, you try and line up that investors for another deal, wouldn't you?
That's right, yeah. But generally, it's the investors themselves saying, look, what have we got now? We like this one. What can we do next?
Okay, interesting.
Yeah. So what's that? Next. Benefits and risks. So benefit shared expertise, access to larger, more complex deals. Yeah, reduced individual exposure because if like a joint venture partner is doing a number of different deals, because quite often in a joint venture, it doesn't have to be one single investor partner. It can be multiple investor partners, and people can like I think you're doing, Keith. You're spreading funds across different projects,
Yeah.
and in the projects that you're investing, it's not yourself the only investor. You're doing it alongside probably other investors. And then some of the risks, poor communication or unclear agreements. That obviously is, yeah, because it can start out like friendly with a handshake, but even if like relations are like perfect at the beginning, it's still needed to cover all the different cases and things that can happen.
Yeah. Yeah.
Typically on a joint venture, I think we might cover it later, but I'll say on this slide anyway, is that there's going to be a legal agreement, which is a shareholders agreement. which is generally drawn up by a solicitor, except sometimes on smaller deals. We use a template that exists, and rather than, yeah, because it's going to be £2,000 or £3,000 to have one of these drafted each time. Sometimes if it's a small deal, like just like a straightforward house to HMO conversion in a low cost area, we'll say, look, we're just going to do our shareholders agreement, register the shares on Companies House, etc. Have the accountant appointed, give each person, if necessary, access to the company accounts, and just get on with it. But on the bigger ones, there's a shareholders agreement drafted. But they're also to save like costs. And this is also, so I'm going on about this is a bit of my advertising when we're helping developers set up joint venture agreements. Even if we've got the developers paying us obviously the consulting cost, quite often that the costs that someone might be paying us, maybe they might be paying us three, four, £5,000 to help set up an agreement. But what happens is, and we do on our own projects, we're producing a detailed head of terms. So we're making sure that all the agreement is really clearly and perfectly set up, so that when we hand that head of terms to the solicitors, they know exactly what they're going to do. They're translating that into legal terms. Obviously, they might be raising some questions that we hadn't thought about, which obviously is their role. But rather than having each side with their own solicitors and like taking ages and racking up very high bills, detailed head of terms can be obviously is really useful. Here are a few examples of joint venture projects. These actually are all live deals that are available for investment. So we've got this one here, it's in Gloucestershire. What this one is, this is a interesting one in that we always like to do things that are a bit creative and reduce a little the risks. This one we've agreed a purchase on the basis of an exchange and 12 months delayed completion. And what this project is all this land belongs to this pub, which is here, which is an operating pub. It's got like quite good income and acceptable profit levels. So what it is, we've got the pub area. On this part here, it's a function room, and this part here is a self-contained holiday cottage. And within the pub, all of the first floor is actually soundproofed, is owner's accommodation. So currently, it's operating just as a pub and a holiday cottage with not very much marketing. Our plan is obviously to get the is to purchase it. We're going through the legals at the moment on this one. We'll immediately increase the occupancy of the holiday cottage by better marketing, and actually we can reconfigure it so we can put 6 people in there. They're currently only advertising for up to 3 people. We'll use the first floor flat as an immediate additional holiday let. And then we're going to be applying to convert the function room into 2 serviced accommodation units, which according to planning policy, because it's a touristic area, that should be basically approved at the drop of a hat because it corresponds to exactly what is needed in the area. We're going to continue operating the pub under management and get the income from that. So what this project is within 1 year, when we need to complete, we'll have 4 serviced accommodation units and the income from the pub. So we'll have a new valuation which will enable us to complete the purchase with no additional money in. And all this land here, we've consulted with the local planner. We're most likely be able to get planning permission for a couple of houses on the land. So it's a two-phase project. Phase one is to get all this up and running and profitable with the serviced accommodation. And on that one, when we refinance, we're looking to be able to get all the initial investor money out. And obviously, there's ongoing income. And however, if we have the planning on here, the investor money that comes out will go directly back into the development for the houses on here. So we're going to be a second time within the same project recycling that cash. So at the end, the investor money will have been more or less doubled, and this part we're going to be selling off and retaining that for the ongoing income. So that's an example of one joint venture project that is available for investment, and that requires 100,000 upfront to be able to complete the exchange, the planning, the different acquisition fees. And once we've exchanged, when we exchange, we have full use of the property. And also we're going to be obviously applying for the conversion there, and the second 100,000 over 6 months is going to be funding the conversion of this to the two serviced accommodation units, obviously adding value to the property.
Yeah,
So that's
yeah,
one example of a joint venture.
that's a lovely project because you've got. I mean, what I like about that is the potential to expand out, and then you've got steady income coming from the club, haven't you? And
That's
then
right, yeah.
this is
And
what.
what we will actually be considering is potentially on here, than that will be a decision between myself as the founder partner and the investors that come on board. If there's like an appetite to leave a bit of money in the deal, we might decide to build here maybe a block of 6 serviced apartments
Oh,
and refinance and retain for the ongoing income.
okay, wow.
So yeah, we've got different, and that's the thing when, and that's like sort of important of the joint venture partners that you bring onto a deal. It needs to be people that are able to communicate with each other, discuss things, and be able to, if basically to, from common sense, to understand that once we've started something, if we realize that if we do this instead, it's going to be better for everyone, that people will say, yeah, we're going to do that. Or someone might say, we like that idea, but have we considered that? And in the end, we don't do it.
Yeah, they need to be adaptable to the
That's
project.
that's right. Yeah,
Set in stone. I can see that if you go for planning and all that, nothing's set in stone. And it's all about profit. Once you can demonstrate it's profitable,
that's
then
right. Yeah,
okay. No, I really like that project. I really like what you're doing there, and
yeah.
yeah,
And this one is an example of one that's actually almost complete. We've already started working on the refinance on this one, and probably we're going to be ready for building control sign off within a couple of weeks on this one. So this was offices, and we've converted that into a 2 flats, and behind there is like a maisonette. So on this particular project, the way that it worked for the initial investors is there was 230 that went into this deal. And the investors here, when we finish the refinance, which will be by the end of the year, they get half of their money back,
mhm.
but then they have an ongoing share of ownership in the property. And potentially within 2, 3 years, we might refinance and get yeah, more money out. In most of the joint ventures, we talk about exit strategy. When it's a joint venture for ongoing income, that means that there's going to be some money left in, but we always set up the joint ventures so that there's a possible exit every 5 years based on an up-to-date RICS valuation. The way that we generally plan that is if it's like 4 or 5 investors and one investor wants to go out, we've got enough margin in the added value to be able to refinance, and then the company buys back the shares from the investor that wants to go out. And obviously, the remaining shareholders then have a larger portion of the pie. If, however, there was like a majority of people that wanted to get out for whatever reason, in that case, then either there's new shareholders that can come in, or if there aren't, then we're going to sell the property
Yeah.
and everyone gets, and that's all that is written into the shareholders agreement. What happens if a lot of people want to get out, and we've got all those provisions. On this particular deal, there are some shares remaining. So there's 8 shares at £4,000 each, expected to give something like 14% return based on the expected income. These actually are shares that I have available in there, which I can sell, and anyone who, yeah, people that want to come into something that's already on the verge of being income producing, there's still that possibility. And that's what we do sometimes on some deals. We've got different levels at which people can come into a deal. And then last example, which we go over very fast. This is a joint venture. This one is in a commercial property. This one again, multiple investors. And this one again is an example. If we go if we actually go quickly back to this one, I'm the only founder partner on here. So I found this one, I'm looking after everything. I'm doing this, obviously, I've got business partners in the area, but as regards the setup, it's myself and the investor partners. Um, this one, again, it was myself and investor partners. This one is commercial property venture. And there's two founder partners, myself and a guy called Duncan, who's
Yeah.
a Emirates commercial asset manager. And this one, again, this one, there's no real building work as such. There's going to be a bit of work in the sense that the ground floor is fully occupied, the first floor is vacant, which is why we got a really good deal on it. This project gives an immediate 8% return, annual return to investors. And when we get the first floor fully occupied, we're going to be hitting something like 15% return on investment. This is like a long-term investment because on this one, the agreement in the shareholders agreement, which can always be different on each venture, here the agreement is that when we can refinance, rather than returning the money to the investors, we've got to think, what are we going to do next? The agreement here is that when we refinance, the SPV, so the company that's set up to buy this property, will actually buy a second property from the refinance. So that after once we've done that after 2 to 3 years, we're looking at hitting 20 to 30% ROI. And someone that's put 100,000 in, that will be worth probably something like 300,000 after 4 to 5 years because
Yeah.
of the two properties of higher value. So yeah, it's just an example of how a joint venture enables hands-off investors to come in with experienced developers. In this case, Duncan has got a lot more experience in commercial property than myself. So we're doing that together. This is a little table that gives a comparison with different types of investment. So we've got like standard buy to let. So that means it's owned 100% by the investor. Typical return 6 to 10%. Risk level moderate. I put involvement high. Obviously, it can all be put under management. Possible to use sources to find a buy-to-let property. We do find buy-to-let properties for investors, but then the returns are going to be going down to like 5 to 8% because obviously there's management fees on them. When it's a joint venture, obviously it's shared ownership, but the returns are a lot higher. We put involvement medium, it can be sort of really low. It's just that some joint venture partners, probably yourself, Keith, if you're coming into a deal, you like to have a chat about what's happening, dig a little bit to understand different things. So there, in reality, the involvement is low to medium. And then fractional ownership, that's a bit like the one that I mentioned just now, I think option joint venture number two, which is a project that's almost finished and almost on the point of being refinanced. So there is more like coming in, buying shares in a property that's already complete. And for the ongoing income, now put typically 8 to 12%. In this one, it's likely to be around 14%. And the risk is lower because it's something that's already completed and income generating. In the case of that, this one, which is the 3 units, we actually do have one of the units complete and rented out on the short-term lettings for, in fact, for the last couple of months. So we've already got some income coming in from this joint venture. We're almost at the end of time. So yeah, structuring a joint venture properly. So obviously all the agreements need to be in there, the exit plan and timeline, roles and responsibilities, especially if there's two active developers in there. How is decision making done? How is the capital repayment sequence? That means also generally, if there's an agreement in a venture that when it's finished, the investor shareholders must get all their money back, but there isn't enough margin in there because maybe the end value isn't what we expected. We have mechanisms in there so that if there's ongoing income that normally would be shared between, let's say, myself as founder partner and the investor partner, until the capital is repaid, then the investor partner gets 100% of the income. And when they've got their money back, then the normal split takes place. Yeah, and then there's different types of resolution mechanism. There's one which is like the Russian roulette type one where someone says, "I'll propose this much to buy your shares," and the other person says, "Okay, I accept that," or "You have to buy my shares for the same price." Sometimes we use that one. And then the other one is more like a mechanism based on a up-to-date RICS valuation. And then, yeah, the other person being able to leave on that basis. So yeah, it's always a specific limited company set up for each project. Written joint venture agreement. In practice, a joint venture agreement, we're not going to go into the details of this, is there's going to be a shareholders agreement, which is a private agreement that's not sitting on company's house. In some cases, to make things a little bit more secure for different parties, we might modify the articles of association. And that the difference there is obviously the articles of association. The both are legally enforceable, but modifications in articles of association are binding in the sense that it's not possible to do something with a company if it's against the articles of association. Whereas if someone does something that's against a legally binding shareholders agreement, then that has to go obviously to the courts to be able to be sorted out. But things that are in the Articles of Association, if the Articles of Association say this share class has got double the income of another share class, then it has to be done in that way. So generally we've got a split. Sometimes we just use the standard articles. In some cases we might do some modifications. And then there's always going to be a shareholders agreement. And then normally we're just designating who's the accountant going to be looking after everything and yeah, other different aspects.
Brilliant. I mean, as always, I'm always impressed with your creative setup.
Yeah.
Yeah.
Yeah, because we're combining yeah, sometimes creative things. Also, we creative deals with the vendors.
Yeah.
And yeah, and sometimes in joint ventures, we'd actually have the vendor of the property coming into the joint venture. So sometimes we'll agree with someone, look, we've got value in this property, but rather than buy it and have all the finance costs, we're saying to the vendor, come and join us in the joint venture. You have a share of, you transfer the property into the SPV. You've got a share of the ownership, and
Yeah.
generally there they come in with redeemable preference shares, which means that when we finish the development, they get paid back the original value of the property. This is agreed within the shareholders agreement. They get paid a percentage of the profit, and then they're out of the deal, and it's the investor and like founder shareholders that remain in the deal. And all these things are possible, and that's where we're advising people on how to set up properly the deals. Yeah, so joint ventures combine money and expertise for high yielding property results. Obviously, it's important that the people um, working together know each other, trust each other. I know people talk about three things. One is know each other, trust each other, and actually like working together. Because it's possible to trust someone but not have the same like approach. Some people don't like jokes, so there's no point in working with me if someone doesn't like jokes and wants to be serious all the time. And there's also sometimes a question of which is probably more my approach, is yeah, we're going to look at things, but at the end of the day, it's a question of not spending ages deciding. It's make a decision and get it done and get on with it.
Yeah.
And I
Yeah.
tend to work well with people who've got that sort of similar, yeah, similar mentality, rather than the approach we're going to do 300 Excel files, work out exactly the figures, and then make a decision when it's too late.
Understood.
Yeah, so, but I'm not saying that that's a wrong approach. If people sort of are really comfortable with that approach, then it's best to, yeah, find a joint venture with someone that also has that approach. So yeah, get to know the people that you're likely to be working with, and if you can basically have good communication and be able to make decisions and not end up exasperating the other person or the other people on board. So, questions, answers, comments?
Well, thank you very much for the presentation. Again, you put the point across. I've learned a few things today, actually. Sometimes it's in the detail. And again, as always, you're very creative, and that's what I like about you. You make it happen, and hopefully do it in a way that all parties are on board and happy to go ahead.
Yeah, no, that's right.
And I like some of the things you presented as well. I mean, like I said before, I've got some things going on myself, but I'm impressed with what you even illustrated on today's presentation, the way you've got it structured. Okay, all
Yeah.
right, yeah,
Yeah, and the key thing in a joint venture is if you've got a good deal that really is a deal and is able to generate the return,
yeah,
then people are obviously, if they want to go into a joint venture, they'll look at it and they're happy going into it.
yeah,
If you're trying to make a deal which is not a deal into a deal and persuade someone to come on board, which is sometimes what happens, someone will say, can you help us set up a joint venture? Can you advise us on what to do? And
yeah,
we'll say, yes, let's have a look at it. And we'll advise them what to do. Sometimes we'll advise them, don't go ahead with this venture because you're trying to squeeze money out of something where if one thing goes wrong, then everything collapses.
yeah.
So we're advising you not to go ahead with it.
Okay, okay, interesting.
Yeah. Great. I'm going to stop the recording. So yeah, thanks for
Thanks.
listening, and for those people listening as well. And
Yeah.
obviously contact us if you've interested in any of the deals or interested in getting advice on how to set up joint ventures.
I feel like I've had a one-to-one. Feel privileged. Thank you, Trevor.
That's right. Yes. A one-to-one, but so you'll be famous, maybe with some people who are going to be listening to that.
And like I said, I know you recorded it, so I can't wait to review it. I think I'll definitely be reviewing this one because there's lots of little snippets of information that I'm not aware of, which I'll be logging in the old computer for a future.
Yeah.
All right,
Great.
brilliant.
Well, thank you, Keith. I'm going to stop the recording now.
Okay. Thanks, Trevor.